take off, take flight with you. For we never fly, but we're flying.
Welcome back to Take Flight Podcast. This is episode 107 with myself, Daniel. And you probably guessed it, it's a Take Flight takeaway. In our last episode, we spoke about a notable investment by the late Kobe Bryant. And there's been a lot of talk in the media recently over here in the UK and the US over the matter of inflation. And certainly in the UK, the pressure for the Bank of England to increase interest rates. And if you follow me on Instagram, you'll have seen me post more in the last few months and weeks to encourage people to invest. In this Take Flight takeaway, I like to give you the basics around what inflation is and what it affects, what the current rate of inflation is in the UK, what's the correlation between interest rates and inflation, and of course, your salary. And lastly, why investments are important. This will be a basic episode, and I don't want to go into any great detail, so please do follow me as I attempt to break it down. So to start with, what is inflation and what does it affect? In essence, inflation is the decline of purchasing power of a given currency over time, meaning £100 today will be worth less £100 next year and even less in subsequent years. It can be reflected in the increase of an average price level of a basket of goods and services in an economy over some period of time. So what a basket of goods is, it refers to usually a fixed set of consumer products, usually measured in the CPI, which is the Consumer Price Index, and services whose price is evaluated on a regular basis, often monthly or annually. The basket then is used to track inflation in a specific market or country, so that if the price of the basket of goods increases by 2% in a year, inflation can thus be said to be 2%. So in the UK, so switching over the Atlantic for a moment, the US inflation has, I think it's at an all-time high for it's the highest it's been in the last 30 years. And in the UK, it's the highest it's been in the last decade. So inflation in the UK climbed sharply to about 4.2% in October. And that's the highest it's been in a decade. And this has been driven by rising fuel and energy prices, which is measured in the basket. This has now added pressure to the BOE, Bank of England, to raise its key interest rate at its December meeting. As I just mentioned, there's pressure on the Bank of England to increase its base interest rate. But what has interest rates got to do with inflation? So inflation affects interest rates also, because the higher the inflation rate, the more interest rates are likely to rise due to lenders demanding more money or demanding higher interest rates as a compensation for the decrease in purchasing power of the money they are paid in the future. Then what's the link between inflation and salary? If we take a basic example here, and I'll use the 2% inflation rate, which is actually the Bank of England's annual target to help sustain growth and employment. So if you say you're on £50,000 a year with an inflation rate of 2%, you will need an annual salary increase base of £1,000 just to have the same purchasing power you did the previous year. That's not even to reflect the hard work you've done. So in essence, every person's base salary should increase in line with inflation. But we know that's not always the case, depending on what company you work for or what industry you work for, whether you're in the public sector or private sector. That can sometimes be very difficult. So essentially, you are worse off each year due to the inflation rate increasing year on year. And personally, for me, I'm always in favor of a base increase as opposed to a bonus, which is tax deductible, just down to the rate of inflation and the fact that inflation needs to be factored in. So please do consider this when you are having year-end evaluations or you're coming to negotiate a salary increase. Always try and beat inflation is a given, but then add on top what you want to get more from as well. So why have I linked inflation to investments? Bank of England interest rate right now is 0.1%. And for those who don't know, the interest rates are done on a voting basis, on a voting basis and on a monthly basis. So the Monetary Policy Committee meet on a monthly basis. There are 9 votes, and there needs to be a majority for the interest rate to either remain the same or the interest rate to rise. And with that, 0.1% really is not going to do a lot for your savings. It's not going to do squiddly do, unfortunately. So if you invest over time, your money is going to grow. If you leave it in the bank, it's going to accumulate 0.1 interest rate, which isn't really worth a lot, nor is it even competing with the rate of inflation. And thus you have less purchasing power going forward. Or if you're old school, I don't know what you be doing, but if you stuff your money under a mattress, it's really not doing you any favors because that cash is going to be worth less in the future. If you're looking for investments, and by no means am I endorsing you to invest in what I'm about to say, these are purely used for examples. But if you were to invest in the FTSE 100, and that's an index which represents the top 100 companies on the London Stock Exchange by market cap, the annual that's been around since I think the 1984, the annualized return is about 5.77%. I'm using that as an example. But if you want to invest, there are many other indices you can invest in. The S&P, there are Vanguard, total shares return. There are many indices out there on different stock exchanges in different countries that you can invest in, so that over time your rate of return beats inflation, beats the interest rate on savings accounts, etc., etc. So I would really consider and implore you to explore what opportunities are out there for you. We live in a day and an age where there are many opportunities for us to invest, whether that be cryptocurrencies, whether that be equities or indices, mutual funds, commodities, whatever it may be. There are many options out there that will definitely beat your bank. I'm not saying you're going to get them all right. Of course, some don't always accumulate or rise in which we would like them to or hoped for because of market conditions. We can't control the market. But I'm sure over time, it'll be better than that 0.1% in the bank. But please do your own research, find out further on what you would like to do so you can make key informed decisions that will impact you positively in the future. So in summary, rounding up, I'm stressing the need for you to invest because the rate of inflation is frightening. In earlier conversations on the podcast as a whole, you've probably heard us talk about stocks versus property. And what I'm trying to stress here is not the fact that stocks is better than property, but in essence, the underlying tone was both are investment vehicles with the aim to raise and generate more cash in the future, given market conditions are favorable. So please do your research. I hope you've had a better understanding of what inflation is, how it affects interest rates, how it may impact your salary, how it impacts the Bank of England's decision to rise or keep interest rates the same. But please make decisions that ensure you continuously take flight. Until next week, stay safe and look after one another. God bless.
Take off, take flight with you. Yeah, for we never fly, but